The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The link between the AI boom and inflation. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Bostic.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Romain is going to explain that link in just a bit, but let's show you where things are going in equity markets. You have the S&P 500 at a record high. Any gain on yesterday's advance is a record high, so a new high there for the S&P. And, of course, the Mag 7 doing a little bit better than the overall market. However, we should note that Nvidia, who has been the star of the Mag 7 since the April 8th low, is a laggard today. We are seeing an interesting move here in treasuries because in the bond market, it's a reversal of the steepening yield curve with yields on the 2-year actually rising right now. And the Bloomberg Dollar Index showing a weaker U.S. dollar. Romain?
An interesting day, Scarlett, because two of the biggest overhangs in this market, inflation risks and fears of an AI bubble, are today, ironically, giving both the bulls and the bears reason for conviction. Nvidia's decelerating growth from ludicrous speed to, well, just merely light speed is being shrugged off by the bulls as more a function of trade policy rather than what the bears say is a sign the AI boom is bursting.
I think the boom's just starting. I mean, if you look at these numbers, especially when you factor in what China is going to be, I mean, you know, Jensen talked about 50 billion, 50% type growth number. This just shows the next stage of adoption is actually just starting.
And in fairness, a lot of investors do think Dan Ives' sentiment is right, particularly evidence in private markets, where AI startups accounted for 65% of VC funding in the first half. But just like the public stock market concentration concerns with Nvidia and Microsoft, et cetera, there are concerns that privately held behemoths like OpenAI, Anthropic, Databricks are hoovering up most of that money and masking cracks for the hundreds of other companies in that space. And that actually segues us to that link into inflation, with a critical PCE index report due out tomorrow that is likely to show the persistence of price pressures. That may seem like an odd link to AI investment, but higher inflation would beget higher funding costs for an AI sector that, if you do believe that MIT paper from last week, has generated no measurable returns for 95% of the enterprise AI pilots out there.
Yeah, that raises a lot of eyebrows. But I do want to go back to the point you made about tech startups, because they are staying private for longer. This chart goes back 5 years. And if you look at it, here's the pandemic, and then you can see the number of VC exits from companies they invested in pick up in the second half of 2020 to 2021, and you can see that they peaked right here. Now, since then, VC exits have declined and, of course, now have pretty much stabilized. What is notable is that the IPO share of VC exits, and that is the blue slice in these bars, pretty visible throughout 2021, but not so much in the past 5 quarters or so. You can barely see it. Most VC exits are actually through M&A, which is the orange section of the bars, and to a lesser degree buyouts, which is the yellow part of the bars. So in the first half of this year, Romain, only 27 companies that count VC firms among their investors went public. That is the smallest number in at least 10 years.
All right, as we kick you off to the close, we want to talk about B Capital. This is a tech-focused firm started by Facebook co-founder Eduardo Saverin and former Bain Capital investor Raj Ganguly, a tech-focused fund with $8 billion under management. Pleased to say that Raj, the co-CEO and co-founder of B Capital, joins us right now. And Raj, I do want to talk to you about the sentiment right now out there about this big investment that we've seen in the AI ecosystem writ large, not just in chips, but really the overall infrastructure out there. You've been at the forefront of this with a lot of early stage investments as well as growth stage investments like Perplexity and Ryder and a few others. What is the state of that right now from where you sit?
You know, I think the state of AI is that AI is just getting started. AI is the new electricity, but there's a lot of bottlenecks. The grid is made out of GPUs made by companies like Nvidia and by data centers, and there's a lot of investment that needs to go on there. And I remain bullish on Nvidia and remain bullish on the fact that we're going to need a lot more GPUs to power the next wave of the AI boom.
When we talk about the mismatch, if there is one at all, between what we're seeing in terms of expectations and what we're seeing in terms of returns. And I know there was a lot of hay made about that MIT paper last week. Obviously, a lot of criticism that there was really nothing new in there in terms of information. But I am curious as to how aligned right now investor expectations are with at least the current reality.
You know, I think the paper from MIT is it's spot on, but to your point, it's nothing new. The startup world has always been about taking a lot of risk and trying new things. I think AI has made it such that it's the best time ever that I've seen to be a founder, to build a company. You can be a sole founder now. You don't necessarily even need a technical co-founder because people who have never learned coding are vibe coding and building great products. I think you're going to see a plethora and a boom in terms of the number of startups. And what that means is that a lot of them won't work, a lot of them will fail. And it's probably one of the hardest times that I've seen to be a venture investor because we know that there is the next generation of companies that are going to be built, the last generation of the hyperscalers, the Mag 7 that have really driven the market. I think you're going to see public markets shift to a much broader, a necessary 90, a broader set of companies that are durable and that are really built for the next generation of AI native apps. But you can't just invest in the models. You've got to invest in the power. You've got to invest in the GPUs. You've got to invest in the pipelines that are really going to drive the next wave of AI.
Well, I'm sure a lot of people are looking forward to that next wave because there's a lot of focus on those 7 critical companies right now. Speaking of the Mag 7, I did want to get your take on Nvidia's results and its forecast, which disappointed a lot of people, even though we're talking about pretty robust growth rates here. We've seen the stock, and I know that you don't follow the stock market as carefully as those who track public markets, but it opened lower and it has steadily pared its losses. What does this say about the level of expectations tied to a company like Nvidia and how that may translate into how people view tech startups overall?
Yeah, it's a great question. I think the AI boom is not going to be linear. I think you'll see starts and stops to it. You saw this in e-commerce. For those of us who've been doing this since the late 90s, we saw this with e-commerce. It took 20 years for e-commerce to really get to much more of where it is today. I think AI is going to be faster than 20 years, but I think we're in the first 2 or 3 years of a 20-year cycle. This is going to take time, and I think Nvidia is suffering from just astronomical expectations. It's still pretty impressive growth, and I do think that we need other companies building these kind of GPUs. It can't just be Nvidia, it can't be one company, and I think for the US to be able to continue to be a leader in AI, we've got to see a broadening of the Mag 7. I think we've got to see a broadening of the number of companies that are building the fundamental infrastructure of AI.
I know for Nvidia, at least, there is some concern that the pace of investment in AI systems is perhaps not sustainable. How much do you see that reflected in the private markets?
I think you're definitely seeing it in the private markets. There was a lot of focus on kind of the fundamental models. That focus is now shifting to the AI app layer. You're seeing the big hyperscalers focus on the AI app layer. We're seeing a lot of startups in that AI app layer. It's a really tough layer because there's so many companies that are being built in it. And I think that there is a real stark divide between companies that are legacy companies, which when I started in tech, a legacy company was a 40, 50-year-old company like GE, but now a legacy company is a company like Google. A legacy company is a company that was started just, even a 10-year-old company is a legacy company. And you're seeing a whole new wave of AI native companies. Yeah. I think the legacy companies have an advantage in the data that they have, and if they can figure out how to leverage that data, I think you're going to see some legacy companies really pull ahead, but you're going to see a lot of new AI native app companies challenge companies that were started 5, 10, 20 years ago.
Well, that's an interesting comparison because someone pointed out, we were talking a couple weeks ago with someone about the dot-com boom and the bubble burst in, what was it, kind of 2000 into 2001, 2002. And the idea of who the winners were in that sort of internet race, the idea that Alphabet, then Google, for the most part, let's say, came out on top, certainly when it comes to the search and advertising side of that space. This was a company that effectively didn't exist during that dot-com bubble. It was still a private company, didn't go public in 2004. So where you sit right now, where you are investing in a lot of companies that are in the private space and maybe could one day enter the public markets and maybe potentially be that next big thing, is that a fair parallel maybe for investors in both public and private markets to be mindful of?
I think it is absolutely a fair parallel. We should all learn from, not only from 1999, but we should learn from 2021. There's been frothy periods in venture capital and in tech investing before. I was a skeptic in 1999 about a lot of the companies that were being built that had no real kind of profitability. I think today what you're seeing is that a lot of these AI companies, they are fundamentally profitable. They are profitable because they have very low costs. They're able to have their developers use AI, so they have less development costs. They're able to have AI-driven customer service. And so there is fundamentally better profitability. But I think what a lot of venture capitalists are looking at is that companies are getting very quickly to 10 million, 20 million of revenue. But that doesn't imply durability. It takes, I think it takes a track record of 3 to 5 years to really prove that you have product market fit. And we can't get fooled again by companies who, in a very short period of time gain a bunch of traction, but they're not solving a fundamental problem that their customers have. They're much more about experimentation.
All right, Raj, always smart and always great talking to you. Raj Ganguly, there he is, the co-CEO of the founder-focused and founder-led B Capital. As we continue the program here, counting you down to the close with a focus on Nvidia and the market moves around it. Lisa Shalett, CIO over at Morgan Stanley Wealth Management, joins us in a sec.
Plus, back-to-school shopping in full swing as summer draws to a close. Sad face. I know, sad face. We'll get a check on the retail sector and the state of the consumer with Stephen Yalof. He is Tanger president and CEO.
And speaking of the state of the consumer, a push ahead to tomorrow's inflation gauge, at least the one that the Fed prefers, the PCE data, a conversation with RBC's senior chief economist, Francis Donald. All that and more coming up in a bit. This is The Close on Bloomberg.
All right, stocks getting a lift. We had data showing jobless claims staying pretty much where they were before, and GDP data showing the U.S. economy grew faster than initially reported last quarter. Now, much of that fueled by companies rushing to import goods ahead of tariffs. Where does that leave the market when it comes to expectations for the rest of the year? Lisa Shalett, Chief Investment Officer of Wealth Management at Morgan Stanley, joins us now. So, Lisa, GDP clearly backwards looking, the jobless claims more current. The next data points, though, are going to be key. PCE and jobs for the month of August. With the September rate cut of 25 basis points pretty much baked in at this point, how comfortable are you with current valuations?
Look, I think we have to just take a step back and ask ourselves what's going to happen with the earnings. I think if you look at this market, when all is said and done, earnings this year are up about 10% in the market. The S&P 500 is up about 10%. Overall valuation multiples are actually flat. And that is telling us that, look, we've squeezed about as much as we can squeeze out of price earnings valuations and valuation ratios. A lot of the valuation in the market, as we know, is concentrated in those top 10 just behemoth stocks. And so it's all going to come down to earnings as far as we're concerned. And there we think that the story is one of stock picking, right? We think that certainly some of those top names are going to continue to be earnings compounders and probably grow their earnings double digits. But if, in fact, the capital spending boom that we're in and that we're seeing continues, there are going to be other places to invest.
Well, I am curious about that capital spending boom. I was looking at the GDP report, and the thing that struck me was the pace of business spending. I think it was like 5.7%, which is not only phenomenal, but like triple what we saw on the personal consumption side. I know that can't sustain itself long term, but do you think that it will settle at a level that is higher than historical norms?
Well, it depends on how long, right? So do I think that we're going to go through a period where capital spending in many ways aided both by the generative AI and all the interrelated infrastructure build gives us a boost, and certainly the one big beautiful bill will give us at least a one-year boost? Yeah, I think the question is, where are we in this CapEx journey? It's interesting. A lot of folks think that we're in the first or second inning of the generative AI infrastructure build out. I'm of the mind that we're a little bit closer to the sixth inning, at least when it comes to data centers and some of the power grid investment. And so, maybe this has got another year and a half to run. But then I think capital spending, as it always does, settles back and we have to digest capacity.
So if you believe we're in the sixth inning, it might be time to start looking ahead and think about where you want to diversify away from those big cap tech. Where do you go to? Which sectors do provide value at this point, or which groups of stocks? Whether it's small caps, whether it's international stocks, whether it's just long ignored certain consumer names.
Yeah, so for us, that's a very easy question right now because we're finding a lot of stuff that we really like and that we want to own. So we're big owners and buyers of global financials in the U.S., both the large cap guys and the mid cap guys and regional banks we like quite a lot. But, the global financials as yield curves really around the world steepen as we get some of the developments around deregulation, some of the developments in stablecoin and in the digitization, digital asset space. Financials are a key sector for us. We also like energy and energy infrastructure, as we alluded to. Investment there is going to have to continue, and we think that there are a host of winners again around the world. Industrials, another place where we're finding pockets of value. And last but not least, we would say healthcare. We are believers in the fundamental underlying demographic trends here. And we think, healthcare has continued to kind of maybe get beaten up unjustly when you actually look at the fundamental growth of the cash flows that many of these companies are putting up. So we like that. Emerging markets, another one of our favorites.
Yeah. All right, Lisa, we have to leave it there. Great stuff as always. Lisa Shalett, CIO over at Morgan Stanley Wealth Management, coming up here on the program. A closer look at the consumer and a closer look at that so-called de minimis rule. The tariff exemption ending at midnight. A conversation on that when we come back after the break. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations, and we start with international paper. Bank of America boosting its rating to buy, citing expected price increases next year that the analysts expect to outweigh near-term operating issues elsewhere in the business. Next up, Wynn Resorts. UBS raising its rating to buy, hiking its price target to 147 from 101. The firm bullish on that casino resort project in the United Arab Emirates. It's opening in 2027, which would make Wynn the only gaming operator in the UAE. Those shares on a 5-day run. And finally, Kohl's. Gordon Haskett says the name back in style, boosting its rating to accumulate, raising its price target to 18, saying the retailer's second quarter earnings should keep management's near and medium-term outlooks on track. Those shares, which had surged 24% yesterday, giving it back about 5.5% today, and those are some of our top calls. We do want to stay in the retail space and focus in on the so-called de minimis tariff exemptions here in the United States. Those exemptions expire at midnight tonight. The gist of it is any goods that were coming into this country under $800 effectively were not subject to any major import duties. Joining us right now to talk a little bit more about this is Tyler Radke, Citi's co-head of U.S. software equity research, who covers a lot of companies in the e-commerce space. And Tyler, I just want to set the scene. This de minimis rule, or exemption, I should say, has been around forever, since like the 1930s. But at some point about 10 years ago, it increased dramatically. A $200 exemption went to $800 exemption. And starting tomorrow, that drops to a $100 exemption. Who does that affect most?
Yeah, so I think the reality is we don't know the exact impacts. Obviously, this happens tomorrow, but a couple interesting things that I would call out. So again, on my coverage, we cover Shopify, Adobe, Salesforce. These are players that target large merchant B2C companies. They help them launch their websites to sell goods to consumers. We also cover some of the marketing automation vendors in that space, be it Klaviyo, Braze, HubSpot as well. Now, go back to last quarter. There was a lot of concerns for Shopify. The stock went down, call it 50% from the highs on many of the tariff concerns in the month of April and May. What happened last quarter, in the June quarter? You saw their strongest GMV performance in several years, over 30% growth. And by the way, China took place, the de minimis exemption expired for China in May, and that had virtually no impact for them. And Shopify also said on their last call that only about 3 to 4% of overall GMV is subject to this de minimis impact. And so we don't think it's going to be as significant. Obviously, there is a lot of uncertainty with these things, but it did not have an impact last quarter with China rolling off. And again, it's not a huge part of their business.
Are the companies saying that this is something that could potentially be a source of confusion or a headwind going forward? Because it hasn't been activated yet. It's August 29th when the rest of the world loses access to de minimis.
Yeah, so I think ultimately the key question is, what does this do to consumer demand, right? And so I think in certain circumstances, right, this could have a negligible impact, right? If the cost of something is only going up marginally. And again, the Shopifys, the Klaviyo's of the world, they tend to cater not to your discount retailers, right?
Yeah.
These are generally more higher income consumers that are buying from Shopify merchants.
Yeah.
So overall, we're not expecting a huge impact on this.
I am curious, though, what the potential impact could be on sentiment. Bloomberg has a great story today with some anecdotes from folks who have already been hit potentially with higher bills. One guy who was shopping for computer parts and all of a sudden received a $1,000 bill that he had not expected, primarily because of the exemption of this rule. End of this exemption, excuse me. Yeah. I mean, there could be some surprises. We actually have our Citi Global Tech Conference next week here in New York City. We have the Shopify CFO on stage presenting on Wednesday, Thursday. So that will be a great question. Hopefully we get an update on just what they've seen. Obviously, it will have been less than a week at that point. But, certainly we'll be watching this carefully into September.
All right, definitely something to watch for then. Tyler Radke is co-head of U.S. Software Equity Research. Thank you so much for joining us. I would be so mad if I got a package and then I got an invoice saying you now owe this amount. Yeah. Well, actually, I wouldn't get the package, right? I just get the invoice first.
You get the invoice first, and I guess you can just not pay it, but you don't get your goods either.
Right, and you've already paid for the goods, so then you're kind of stuck, right?
Okay, this is kind of weird. So what does this mean? Shop local? Or not shop
basically, you got to look into the provenance of everything you want to buy. All right, coming up,
we're digging deeper. We can go to a Tanger
outlet.
How about that?
There you go. Digging deeper into consumer consciousness with Tanger president and CEO Steven Yalof. We're going to ask him about the state of spending, his company's latest earnings report, and the biggest risks facing the retailers. From New York, this is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Scarlett Fu. And of course, we're keeping an eye on retailers because it's the thick of earnings season for these retailers. And we've gotten pretty much a mixed bag here for the ones that have reported.
Yeah. Dollar General come out. They actually reported better than expected earnings. And that maybe is due to the idea that we're all looking for values. Burlington stores as well. Then you had like Best Buy.
Which actually did better.
But they did raise some concerns about tariffs and how that might affect things going forward. Then I don't know what the heck's going on with Bath & Body Works. Have you ever been in a Bath & Body Works?
Not in a long time because I don't want to smell like, cherry blossoms in the middle of winter when it doesn't feel season appropriate.
What about in the middle of summer?
I guess I could do that, but
it gets to the idea of where people are shopping. And we get some earnings after the bell, we should point out too. Gap and Ulta. So beauty, as Alex Seal would say, invest in your face. And Gap would just kind of become a bit of a turnaround story. And our next guest has a little bit of connection to that.
Yes, absolutely. But the cultural relevance of Gap is still about one that we can't really answer yet. I mean, it's in a turnaround mode, but its glory days, it feels like, are behind it. So it has to kind of, reintroduce itself to a new audience, right? All right, well, when it comes to the consumer, we're not seeing signs of a slowdown in the consumer. That's the message, at least, from Dick's Sporting Goods following its latest earnings. And of course, we do await the release of PCE tomorrow, but recent economic data have showed a solid spending picture, at least on goods, in recent months. Our next guest has his pulse on the state of the consumer and the biggest risks to spending. Steven Yalof is president and CEO of Tanger, the REIT that owns and operates outlet malls, and he joins us now. Steven, great to speak with you. And just on the heels of what we were discussing, the latest batch of earnings really show consumers are spending despite uncertainty over tariffs and longer-term inflation. The wrinkle, as Romaine pointed out, is that everyone wants value. How is that showing up in your malls, in foot traffic and in sales?
Well, we are a value platform. So we're really where the customer wants to shop, where their favorite brands, the best possible price, every day, and we're seeing the customers show up. If you go back to tariff, you talked about tariffs there for a little bit, and you think about tariffs being announced in April. Well, we've seen traffic build since April. So it's been a pretty interesting story, as customers might have anticipated some issues in third and fourth quarter. So we did some pretty smart things. We induced the customer through back to school to start shopping a little bit earlier. And as we've gotten that customer earlier, it's really resonated. And in fact, as the tariff impact was not as strong as some of the customers anticipated it would be, particularly in Q3, we see that customer actually coming back for a second visit. And our retailers are saying to us, well, what are you doing to get the customer in earlier for holiday shopping? So that's what we're working on right now.
Gotcha. Well, of course, hand in hand with tariffs is geopolitical tensions with other countries. And we know that there have been fewer foreign visitors to the U.S. anecdotally. Domestic travel is up, but maybe fewer Canadians coming to the U.S. Is that showing up in any material way at your malls?
Most of our shopping centers are really drive-to domestic tourist destinations, places like Savannah, Charleston, Hilton Head. So we're still seeing a lot of those folks who are going on their holidays come and visit and shop with us. In fact, our summer traffic numbers were outstanding this year. But what's more important is that our centers that, 10 or 15 years ago, the narrative on outlets they were far away from most of the centers of the cities. We're seeing a lot of folks moving back to those geographies. Secondary homes becoming primary homes, just because of how the customer is working today. And because of that, we're seeing a lot of traffic during the week. So our traffic continues to build in those domestic tourism markets, and it's also driven by the local consumer as well.
I am curious. Obviously, Tanger has a very specific focus that allows that brick and mortar model to shine through in a way that maybe it doesn't for other segments of retail. I mean, we were joking before this, or kind of mentioned that you had a connection to Gap. You were basically the real estate guy, although many moons ago. And we had Mickey Drexler, your former colleague, on a couple of weeks ago, kind of talking about the transitions that we've seen in that space. Is there hope for maybe the more higher-end retailers, or the retailers that maybe need to be more e-commerce focused? Is there still a place for brick and mortar in their strategy?
Well, I certainly believe so. In fact, I think a younger consumer wants to shop brick and mortar. I think online is definitely part of the journey. So customers like to window shop online, but they like to execute in store, particularly if they're buying fashion items. So if they're buying, whether they're buying Gap, they're buying Prada. The customer wants to feel the fabric. They want to try things on. And I find that to be true in footwear, as well as accessories, as well as fashion apparel.
There's also been, you've made some expansions and changes to the Tanger model itself, making it a little bit more, I guess, experiential, for lack of a better phrase. Talk about how much progress you've made on that so far, and whatever plans you can disclose publicly to go further with that.
Well, sure. That's an important part of our business. Pure play outlet shopping was a real fun thing 10 years, 15 years ago. But now what we're finding, particularly as our centers have become more and more important to the communities that they serve, that the consumer wants more when they get off the couch and come shop live. And that's better food and beverage offerings, more entertainment opportunities, whether it's a Dave & Buster's, a Main Event, or a movie theater. They're looking for better amenities. And also with Tanger Loyalty, we're gamifying the situation. When people come and shop our centers, we're rewarding the customers for coming to shop with us. So the more they spend, the more they're rewarded, and they can use those rewards across any Tanger shopping center across our entire portfolio.
Stephen, I'm wondering if you've observed whether there's a saturation point for the number of factory stores for certain brands. I'm just looking at J.Crew, for instance. It has about 117 regular stores across the U.S., but there are about 369 factory stores. And some could make the argument that that is devaluing the brand, watering down the brand. And I wonder how that might show up across your outlets.
Sure. But first of all, I love what J.Crew is doing. And J.Crew not only presents their outlet brand in outlet centers, you're seeing a lot of J.Crew outlet stores in non-outlet centers as well. So I think J.Crew's identified the fact that there's a customer that loves their brand, loves their style, loves their fabrications, but wants it in that value price point. And if J.Crew can provide that customer the value price point as their entry level, get them into the store, get them to buy the product, I think it's then J. Crew's opportunity to trade that consumer up to the more expensive products and make that customer a customer for life.
Do these kinds of companies, whether it's a J. Crew or another kind of company, need to provide more than just apparel? Can they turn themselves into a lifestyle brand at an outlet level?
Well, that's what I think is so exciting about the outlet stores. There's plenty of places to buy discount. There's secondary discount stores. There's discount stores that sell product by the pound. There's discount stores that use classification merchandising, where they'll take 5 or 10 brands that compete and put them on the same rack just because they're the same size and the same classification. I think outlet provides the opportunity for all the retailers to produce, to show their product soup to nuts, the entire lifestyle. So if you're a fan of a brand, I'll use Ralph Lauren as an example. If you're a fan of Ralph Lauren, you can buy socks, you can buy shoes, belts, pants, shirts, housewares, sheets, towels. The entire product assortment from end to end is available for the consumer, and it's all Ralph Lauren product. And I think that gives not only the consumer an opportunity to shop the way they want to shop, but more importantly, it gives the brand the opportunity to showcase all of their product lines at an entry-level price point that ultimately turns that consumer into a lifelong consumer for that brand.
Stephen, always a pleasure. Stephen Yalof is the president and CEO of Tanger. And we should point out, we'll get another read on the state of retail after the bell tonight with earnings out of Gap, Ulta, and Petco. And we'll throw a firm in there as well. We're also going to get some tech earnings, another read on the AI space, another read on data centers with Dell. It's our stock of the hour. And as we await those results, we'll have a breakdown of what to expect when we come back after the break. This is Bloomberg. Time now for our stock of the hour, and it is Dell. That company is set to report earnings after the bell. It's expected to raise its forecast for full-year AI server shipments. Jin Ho covers the stock for us over at Bloomberg Intelligence, and he joins us right now. And Jin, this is kind of like one of those kind of old tech companies that has kind of become back in vogue again because of all of the demand for data centers. What's your expectation for tonight, and what type of guidance do you think the company might give?
Yeah, hey, thanks, Romain. So, look, they're going to have a solid quarter in terms of AI servers. I do expect them to book roughly or recognize roughly $7 billion in AI server revenue. PCs is actually going to be fairly good, so there is some scope for upside. In terms of the outlook, look, all eyes are going to be on that AI server revenue number. They've already forecasted out $15 billion in sales for the year. Consensus has started to creep up higher. I thought the $15 billion was conservative. You have some as high as $20 billion for the year. So if they don't meet that $20 billion bogey, they'll be considered a disappointment. Okay, so there's a whisper number here that everyone's working with. When it comes to those AI server shipments, I keep reading about Neo Cloud partners. What does that mean, Jin? Oh yeah, Neo Cloud, new cloud, sovereigns. I guess the best or the most well-known Neo Cloud out there is CoreWeave, right? They've been on the show quite a few times. They're a customer of actually Dell, but there are also some other smaller Neo Clouds or emerging Neo Clouds like Crusoe that are building out AI servers as well. So they're offloading some of the cloud, hyperscale cloud capacity from customers like Microsoft as well as Google and Meta. And they're doing some of their training work for them. So they're doing a lot of the purchasing of these AI servers. I am curious about what's going on with PC demand. I mean, I know there was some uptick in that. It kind of ebbed a little, and now it seems to be coming back. How important of that is something? How important is that for investors to pay attention to? Yeah. So pretty important in the sense from a revenue perspective. We have to keep in mind that PCs still represent roughly half of total revenue, or I guess the personal systems group for these guys, roughly half of total sales. Now, a couple of things, right? We thought that tariff headwinds were going to be a monkey wrench in terms of not only growth but also margins. But that didn't turn out to be the case. If we look at HP's results yesterday, they managed their PC revenues as well as margins well in the last quarter results. And I do expect the same for Dell into results as well as the outlook. So in other words, the PCs are not dead. The PC cycle is alive and well. I guess my question is, when it comes to a company like HP, which makes both printers and laptops, the printers were not getting the similar kind of boost. Yeah, look, printers are still in secular decline for a couple of reasons. Consumers have really not really picked things up, and the back-to-work bump up that we expected from the office printers haven't really helped as well. More importantly, margins fell short of expectations, but we do expect some back-to-school buying for HP in terms of the printer side, but also an improvement in supplies for next quarter.
All right, Woo-Jin, thank you so much. Jin Ho of Bloomberg Intelligence. I think I'm the only person left on earth who likes printers. I print up everything.
Yeah, me too. I mean, but,
Gen X.
I hate to say it, but we're old. Sorry.
Yeah, Gen X. All right, coming up, we're going to take you to the closing bell with Charles Lemonides, ValueWorks Chief Investment Officer. This is the close on Bloomberg. Print it up, Romaine.
AI is just getting started. AI is the new electricity, but there's a lot of bottlenecks. The grid is made out of GPUs made by companies like Nvidia and by data centers, and there's a lot of investment that needs to go on there, and I remain bullish on Nvidia.
Venture capital investor Raj Ganguly kicking us off to the close, a discussion about everything going on in the AI space, with, of course, the big leader in that space not really participating in the rally. But I just took a look at the shares. They're only down about 0.5%. They had dropped about 3% earlier in the session.
Yeah, really pairing their declines. We'll see if they actually make it into the green by the end of the trading day. But, for long-term investors and those who believe in the AI story, like Raj, they say that, expectations, at least from the public markets investors, were just simply too high.
Absolutely. Here, and you take a look at the numbers there on your screen. And we should point out once again, Scarlett, last week of August here, we are in the summer doldrums. Volume is light. So a lot can change when we come back after the Labor Day holiday here in the United States. But we count you down to the close here on this Thursday afternoon with the focus on where markets are going and with the focus on where investors are finding value. Charles Lemonides is the Chief Investment Officer of appropriately titled ValueWorks, and he joins us right now. And I do want to start there first with the tech space here in the U.S. specifically, as to whether you do see value in any of the companies out there in this market chasing that AI dream.
Well, I think that's a really great starting point for a conversation where we are today, because there are some valuations that are very, very robust and hard to argue that you're going to make money. There are plenty that are not that robust. The economic expansion we're seeing and the economic growth we're seeing in AI and that part of the economy is explosive and powerful. Some stocks have gotten way, way ahead of themselves, Nvidia being a case in point, Palantir being another case in point, although not exactly related, but close. That said, I think we're going to an extended boom. I don't think that we are at a cyclical market top yet. I think that's 2-3 years away. So I think investors are in this place where the exciting names have become way overdone, but there are plenty of tech names that are not overdone. And a couple of names we like are Micron Technologies and Qualcomm, which are both totally fair valuations and probably both have a lot of growth also.
And we've heard that from some other investors, too, particularly as they try to look for any sort of alternative to the Nvidias and Microsofts of the world. As we search for value, though, something interesting popped up on the Bloomberg terminal, and that was a stake that you were taking in the wind power company Ørsted. This is a Danish company that makes the big windmills there. The shares at one point had basically dropped to a record low to start the week, down 40% in a matter of weeks, just because of some concerns here about cancellations of some wind power contracts by the Trump administration. We now have learned that you have bought, something more than 100,000 shares of this company in the past few days and weeks. That seems like a pretty big bet. I mean, is this a bet on Ørsted or a bet against some of the policies coming out of this administration?
This is a contrarian bet on Ørsted and on wind, and it speaks to how we invest money and look at the world. 4 years ago, 5 years ago, the wind companies are where the AI companies are today in terms of investor enthusiasm and excitement and how they were going to take over the bloody world. They probably will end up having a huge role to play in producing electricity for the globe over the next 5 years and 25 years. The ability to produce energy and electricity from offshore wind farms is today not like anything it's been in the past ever. And it's going to be an economic growth engine, and it's going to be economic power. That said, investors have turned on the stocks because there have been a bunch of hiccups, and there have been a bunch of bumps in the road, as there always will be in growth businesses. And, the valuation now is, dirt cheap, and investors are completely capitulating and throwing in the towel. So that's where we try to dig in and do the work and see if there's real value there. And in the case of Ørsted, we're pretty darn sure there is.
I mean, there's a pretty big bump in the road when it comes to a Trump administration that is just completely opposed to wind energy or alternative sources of energy, halting work on this project off Rhode Island that's already 80% done. How do you think about this idea that Ørsted can't do very much in the U.S. for the time being? I mean, this is how patient are you willing to be here?
First of all, we're willing to be pretty darn patient. Administrations last for 4 years or so. We owned some gas pipeline companies 6 years ago, and they couldn't get environmental approvals to cross like minor pieces of waterway, and 90% of their pipelines were built, and they couldn't get administration approval to get across the finish line. The administration changed, and they got that approval, and the pipelines have been finished, and we saw 3x on our investment. Difference here is that Ørsted's not a U.S. company, and Ørsted is a very, very global company. They produce a huge percentage of the electricity used in the UK. They're a global player, and their U.S. operations, while they're measured in the 5-10 billion range, are not 25% of what they've invested around the world. So even if the U.S. is a total disaster and a total donut hole, we're pretty sure Ørsted is very cheap from today's price. Mm-hmm. And ultimately, this administration has proven to be very transactional. They're looking for their piece of the action. And up until now, they've always been willing to strike a deal and give something to get something. And we're pretty sure that's how it'll work out for Ørsted on these offshore wind farms off of Long Island and Rhode Island and Connecticut. But if it doesn't, the rest of their businesses protect us really well. And, these things will end up being worth an awful lot of money, we think.
How confident are you that it will be able to place the rights offering? I mean, you're committed to it. You said that you are.
That's a very important point also. Look, in order for them to be adequately funded, they need to bring in billions of dollars. That said, their equity cap today is $12 billion. Their 50% investor has said they're willing to pony up their share. We'd be super surprised if they can't price it in such a way that the $9 billion comes into the company. And that may be, what share price that is, it doesn't really matter to investors because you're going to have the same pro rata interest in this company if you exercise those rights as you have today, and the company will have that money on the balance sheet. So whether you take it from one pocket to and put it in the other, it doesn't matter economically. And so we think that's going to get done, and we think that's important, and we think that that's going to relieve an important psychological overhang in the market. I think the stock will be up 25% once that's done.
All right, well, it's already getting a pop today. Looks like it closed up over there in Denmark, up about 6% here on the day. We'll check back in with you soon, Chuck, I'm sure, to see how things are going. Charles Lemonides is the Chief Investment Officer over at ValueWorks with the story on the terminal about a big bet he's making on a non-U.S. company, Ørsted, the wind power company, Scarlett.
Yeah, a company that's very much, or a company in an industry that's very much in the target of President Trump and his entire administration. Yeah. So it's something that might take a while to play out, right? The bet will have to unfold over time.
And it gets to this idea, too, as we bring it back to U.S. markets, as we get closer to those closing bells 2 minutes away. The big focus on Nvidia, but he's kind of hitting at this other issue, too, the idea of how much power is needed to power this AI trade. So whether it's coming through the traditional utility grid or through renewable energy sources, this has become, of course, a big source of investment for investors as well.
Absolutely. And this is why so many of the tech companies are going out and kind of doing things on their own, looking for nuclear power as their own source of energy to make sure that they have enough power to continue to move forward with their AI, developing their AI build out.
We should point out that right now the major indices here in the U.S. are in the green, only fractionally higher, but given some of the drag that we thought we were going to get from Nvidia last night, certainly something that I think a lot of folks are probably pleased to see. Romain Bostic here with Scarlett Fu. We're counting you down to the closing bells, and joining us here in Studio 2 in New York is Jess Menton and Bailey Lipschultz, who help to lead our equities coverage here at Bloomberg. And guys, I want to start off with Nvidia. We talk about a stock that everybody thought was just going to like tank this market. It did sort of drop about 3% earlier in the session, but as of right now, it's only down about 0.6%, the biggest weighting effectively in the NASDAQ and the S&P 500.
Well, if you look at the implied moves coming into this, especially for this stock specifically, it was supposed to be a 6% swing in either direction. That is low relative compared to where it's been on those earnings day moves over the last few years when it's been more double digits. But actually, if you're looking on over the next month, it was supposed to be the second highest implied move behind Fed Day.
Yeah.
But because the VIX is still closing around its lowest level of the year, those implied moves are still below 1% for the index.
We're talking about a stock that's going to end the day down 0.7%. When you look at the earnings beat and raise, really delivering across the board. We're uncertain about China, but really good print, guys.
Absolutely. And we should point out we are expecting some other earnings in the AI space, and that includes from Dell, the big maker of PCs and servers. As we get the closing bells here in New York, green across the screen. The Dow Jones Industrial Average up more than 70 points, or almost 0.2%. The S&P 500 for the first time ever crossing the 6,500 mark, 6,501 and change. That is a record high, 0.3% higher. The NASDAQ 100 up about 0.6%. The NASDAQ Composite up 0.5%, and the Russell 2000 SCAR up 0.2%.
Okay, so green across the board, but interestingly, you look at the S&P 500 and the number of advancers versus decliners, more decliners than advancers, 278 versus 222. So very much big cap names keeping it aloft.
That would be, yeah, big cap names keeping it aloft, because I thought it was kind of interesting. The S&P equal weighted index actually closing in the red today.
Oh, interesting.
Yeah.
By how much?
Only less than 0.1%.
Okay, so marginal.
So marginally.
All right. And Jess, you were going to say?
Well, I was going to say, I know you're about to get into the IMAP, but I wanted to point out, if you look within utilities, it's those independent power producers.
Yeah.
Even though that sector was lower, that was the one that was higher, and that group was up more than 1%.
All right, so the AI theme plays itself out across the market today. You look at the IMAP, a lot of green there. It's notable that there are 4 sectors in the red, and to what Jess was saying, utilities down 0.9%, consumer staples and healthcare, so more of the defensive groups in the red. Communication services, energy, and tech leading the gains.
All right, we are going to get to some of the other individual gainers and decliners on the day, but we are getting some earnings to squeeze in here. Autodesk, the software company, coming in with its results for the most recent quarter. A beat on operating margin. It looks like a beat on net revenue of about $1.76 billion. The street was looking for 1.72, and a beat on the bottom line of about $2.62 a share. Here's your guidance going forward. For the full year, the company is giving a revenue range, a tight range, 7.03 to 7.08 billion. That's higher than the previous range it had given. And for the current quarter that we're in, the company says that bottom line, the number, adjusted EPS, $2.48 to $2.51, also higher than the average of street estimates. Bailey.
It looks like the stock, maybe the bots or the junior analysts trading the stock, up more than 7% right now. Again, closed around 288, had traded as high just a little over a month ago, north of $315. So working its way back towards that. Again, one to keep an eye on when we get into tomorrow's session.
And then also looking at the gainers today, really hefty moves here in software and cloud providers. So I'm going to start off with Datadog. DDOG's the ticker up over 7%. So its best day since July 3rd. Actually was one of the best gainers in the S&P 500 as well as the NASDAQ 100 here. So you saw other peers on the back of what we saw with that huge move for MongoDB yesterday. Because yesterday had been up close to 40%, so that was rising as well.
And that was a concern coming into this earnings season, the idea that the software companies, particularly kind of these mid-tier ones, were getting left behind.
And then obviously, if you think of sort of the AI trade, now they're catching up. And then also on the back of that, another one that was gaining today, Snowflake, the ticker is Snow. So that also is part of the story that we've seen when it comes to the earnings theme here with those companies. So up 20%, best day since November 21st of last year. And also that company eased some of those investor anxieties that you were talking about, Romaine, because the software vendors the concern that they'd be hurt by slowing economy and new competition when it comes to AI startups. So they're basically kind of bucking that trend there. And then I wanted to point out actually Pure Storage.
Pure Storage.
Yeah, the
this is like the biggest gainer on the day.
It is actually up more than 30%, best percentage gain on record for this company. So it is another cloud storage provider. So it topped those estimates for fiscal second quarter results, and it also raised its 2026 full year forecast, Bailey.
Jess, you're taking the bullish stocks. Let's go with the bearish stocks and talk about companies that are exposed to the real economy.
There you go.
I'm talking about some of the worst performers across a number of indexes, starting with Hormel Foods, maker of Spam. This is a company that really called out cost pressures. Looking at the terminal, ending the day down more than 13%. One of the worst days in history. The reason I say one of the worst days in history, this company was founded in 1891, talked about going public in 1925. So it's been a long time
Great
as
context.
a publicly traded company. But as we talk about the uncertainty around the consumer, they're blaming costs. So certainly something that kind of, again, stands out. One of the other poor performers, gauging or trading to consumers in Brown-Forman, the parent company that makes Jack Daniels.
Yeah, what happened there?
They reported results that were not as good as expected. And when you look at it, underwhelming kind of with what Wall Street was looking for, it does seem like alcohol consumption in the U.S. remaining weak. I don't know about you guys.
So I'm told it's like younger people like you that are ruining the alcohol industry, that apparently the Gen Zers don't drink anymore. Is that true?
We're not Gen Z.
You're
Drink
not?
something different.
It's funny because
Trust me, the Gen Xers are still drinking.
The millennials are too.
I don't know who's buying Jack Daniels. I'm not buying Jack Daniels. You know, I'm more of a bougie Burmick kind of guy, and then just going to call out some of the weakness we saw with Urban Outfitters. That stock down about 11% this coming after a big run up.
All right, we are getting Dell earnings crossing the wire right now. Scarlett, let's get right to it here. The red headline crossing the wire, we're actually going to start with the forecast here. The company says that full year, its AI server shipments will be $20 billion. It had previously guided to $15 billion. So basically guiding almost 30% higher than what it had previously given. Full year revenue, 105 to 109 billion. The previous estimate was 101 to 105. The street was looking for 105 and change. So basically the lower end of the guidance looks like it's coming in above estimates. Now, if you care about the quarter that just passed, net revenue of 29.78 billion, roughly in line with estimates, slightly higher than estimates, and operating income, SCAR, 2.28 billion, roughly in line with estimates as well. Interesting to see the shares actually lower here on the back of that.
Yeah, in fact, we had just talked to Jin Ho of Bloomberg Intelligence, who told us that $20 billion was kind of the whisper number here for the full year AI server shipments. And that was the number that this stock move is really hinged on. Previously, it had expected something above 15 billion. So hitting the whisper number is not enough these days, I guess. In terms of the full year outlook, adjusted EPS $9.55 at the midpoint. Previously, it had seen $9.40 at the midpoint. And Romain, I like what we talked about earlier, this idea that this is an old school tech name that has kind of caught up with the AI revolution and has found a place, a niche place in it.
Yeah, and I want to get your thoughts on this, Jess. I mean, just stay in the tech space for 1 second here. We are getting Ulta earnings as well, but Marvell, the chip maker, out with its results as well. Those shares now moving lower, down about 5% in the after-hours trade, Jess. They're providing revenue figures that are pretty much in line with estimates, 2.01 billion. EPS numbers relatively in line with estimates, 67 cents a share, and guidance on the current quarter slightly below estimates. And I am curious as to where these kind of second tier, and that's not a diss, these second tier kind of companies fit into the AI story.
Well, the big thing 3 months ago, if you think back to last May, so Marvell at that point had actually delayed its investor call, and that kind of rattled the stock then, and it sold off. And then it also had cut the high end of its revenue forecast at the time. So investors were really trying to focus now that 3 months has gone by, was there better guidance there? And Bloomberg Intelligence was thinking that the chip maker's results were expected to align with those estimates. But if you look at this, the stock's still down about 30% year to date. So even if you see some bright spots there, still has a long way to catch up compared to some of its peers this year.
And you mentioned Marvell, that company just coming out with results as well. So speak of the devil, right? Second quarter adjusted EPS 67 cents, matching the estimate. Net revenue 2.01 billion, also in line with estimates. In terms of the third quarter, net revenue 2.06 billion, trailing the consensus estimate. And third quarter adjusted EPS just a penny better than what people were expecting.
Let's pivot just real quickly to the consumer space here. Petco out, and so is Ulta. Let's start with Ulta. Bailey, they're coming out with their results here, and there was a lot of talk about whether people would continue to spend on consumer discretionary items. A beat on the bottom line in the most recent quarter here. $5.78. The street was looking for $5.11. Net sales coming in at about $2.8 billion, slightly ahead of estimates. And the company says that for the full year, it now is providing a comp sales range of 2.5 to 3.5% growth. Bailey, its previous guidance was 0% to 1.5% growth. So a meaningful bump up here in their expectations for the rest of the year.
Yeah, big bump up in comp sales. Even going to call out the expectations for operating margin, 11.9% to 12%, had seen 11.7 to 11.8%. This is a stock right now after hours up more than 4.5%. And when you look at concerns around the consumer, it seems like there is going to be continued spending. And again, we're talking about some of the better or worse performing stocks this year. Both the shares up 22% year to date.
Yeah, absolutely here. And we just should also just real quickly point out, Petco just came out with their earnings.
Petco is absolutely flying.
Put those shares up, please.
And this is a consumer discretionary company. I argue it's a consumer staple. Nevertheless, stock jumping 31% after boosting its full year adjusted EBITDA outlook.
Just going to call out, though, on Petco, 23% short interest, so that could be a short.
Fair.
Jess, final word here.
Well, that's what I was going to say too. But also, it was trading around $30 in 2021. Now it closed just above $3. So
yeah,
a lot of pain
absolutely.
still.
Great context as always from Jess, Menton, and Bailey Lipschultz, who helped to lead our markets coverage here at Bloomberg. That does it for them. That does it for Scarlett Fu. I'll be sticking around with additional coverage coming up after the break of some of those big earnings we just got, including out of Dell. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close, and it was a record high for the S&P 500, a record high without the help of Nvidia, believe it or not. That low volume summer grind higher, pushing the S&P to its first close above the 6,500 mark in its history. Outperformance, at least as of late, a rare outperformance relative to the small cap stocks. The biggest percentage movers out there were still in the tech space. Names like Datadog, ServiceNow, Trade Desk, Oracle, and CrowdStrike helping to push things higher. Apple, Amazon also participating in that rally. Meanwhile, some of the biggest individual movers on the day, you had names like Pure Storage, enterprise hardware and software company up more than 30% here on the day. And just now we are getting earnings in the aftermarket out of a firm. That stock had held its own during the earlier session, but now slightly lower here. That company providing a revenue for the most recent quarter that did beat estimates, but its guidance giving a very wide range that's slightly below on the low end of what the street was looking for. I want to go back to some of the individual movers specifically on this day, and that includes a lot of the names in the consumer-facing spaces. Names like Hormel dropping the most since going public all the way back in 1980. Some concerns here about the rise in commodity prices, and eBay and Etsy under pressure here. In fact, Etsy has been on a 6-day slide. A lot of concerns here about the expiration of that de minimis exemption overnight tonight that basically allowed those firms to allow shipments from overseas into this country as long as they were under $800. Basically, they would avoid any tariffs. And that brings us to our top story, and it really is the state of AI and an economy that has historically been driven almost entirely by the consumer, and that's changing. Personal consumption, it still makes up 67% of gross domestic product. At least it did last quarter. That GDP in the most recent quarter, it expanded at a healthy 3.3% annualized pace. But there was one big asterisk on that. While the dollar value of GDP is still all consumer all the time, that growth rate, at least for right now, appears to be all AI. So-called non-residential investment, a measure of expenditures by companies, that category surged at a 5.7% pace. That was more than triple the pace for consumer spending, a rare outperformance that follows a 10% advance in the first quarter. Two back-to-back quarterly advances in business investment, largely seen as directly related to the groundswell of attention on technology and AI. And that brings us to where we are here in the after hours trade with a closer look at those results that we just got out of Dell. And Dan Niles, who joins us right now, the founder and portfolio manager at Niles Investment Management. And Dan, I do want to start off with where this sort of investment spree in the AI space stands right now, given what we learned out of Nvidia last night and what we're learning in the moment right now out of companies like Dell.
Well, I think you're at this interesting crossroads where if you think about some of the things we've heard over the past 2 weeks, you had Sam Altman, the CEO of OpenAI, come out and say we're in an AI bubble. You had ChatGPT, which they released, really disappoint, where a lot of users actually went back to ChatGPT 4 from ChatGPT 5 that came out. You had that MIT study out that said 95% of enterprises that were investing in AI weren't seeing any return. And then, the final one is Meta, which was spending money on AI researchers like they were, Major League Baseball pitchers, they actually went into a hiring freeze. So you've had a massive surge in AI spending since the end of 2022 when we heard about this thing called ChatGPT. And so I think you're getting to the point now where it's going to get a lot more interesting, where you have to start to see some return on that. And the results from Nvidia last night, if you really look at it, were a little bit on the disappointment side. I mean, it's amazing that the stock hung in as well as it did, because they actually missed Wall Street's estimates for data center revenues, not by much, by just 1%, but it's the first miss they've had since we ever heard about this thing called ChatGPT in 2022. So it's going to be more interesting between now and I think the end of the year.
Well, I am curious about that, and we should point out, I mean, we're coming up on the 3-year anniversary of that. I think that was late November 2022, at least when it came to the public's consciousness of it. And we did hear Jensen Huang and his CFO talk a lot about this on the conference call. And one big component of this, though, has been the idea, at least in their characterization, that their future growth is, at least right now, kind of somewhat dependent, not so much on the companies buying their stuff, but on whether the governments here in the U.S. and around the world are going to allow it to sell its stuff where it wants to sell its stuff. Does it concern you that, at least as of today, it basically has no market in China for its advanced chips?
Well, here's the good news. There was no revenues in China in the last quarter. So there's no real downside from that. It's all upside. As they said on the call when they gave the guidance, which was just about 1% above where consensus was, that guidance was predicated with no China revenues in that guidance. And if they get China revenues, they believe that that'll add an extra 2 to 5 billion to that guidance that they gave, which would raise it by about 6% or so. So it's all upside if you get it. If you're asking from a longer term perspective, obviously the more the U.S. puts pressure on China, and we've heard this over the last couple of weeks, the Chinese government's encouraging their companies to go ahead and buy domestic Chinese AI products, whether it's DeepSeek on the software side or chips from Ascend instead of Nvidia chips. The government would like Chinese companies using Chinese products for obvious reason, because they don't want them dependent on U.S. companies for their technology. So from a longer term basis, China's pushing towards self-sufficiency. This just accelerates the process. And if we're not willing to sell them Blackwell chips, that's just going to accelerate it even more. And so that's kind of something you have to think about for the ultimate market share potential for Nvidia in China and every other company that wants to sell into China.
I'm curious your thoughts on kind of the other players in this space. I mean, we just got Dell earnings. Obviously, they've been a big beneficiary of the data center build out. There are a lot of other companies that have benefited from the AI infrastructure build out. Whatever's going on with Nvidia specifically, whatever's going on with advanced chips, no one seems to think that this AI build out is somehow coming to a halt, that it will continue. Are you in that camp?
Well, I'm not. Well, it depends if you're talking short term or long term. In the short term, I've been talking about, or I started talking about mid last year, how you were going to go through this plateauing or digestion phase in training demand. And you kind of saw that. And what I mean is, if you go back and you look at what happened when the 3 biggest hyperscalers, so Microsoft, Amazon, and Google, reported their results for the June quarter of 2024. The revenue estimates all went down for the September quarter of 2024. And when they reported the December quarter of 2024, the revenue estimates for all 3 of those companies went down again for the March quarter of 2024. Then you had inference demand which really start to pick up. So you had companies like Google say, hey, we're seeing 50 times more token processing in the month of May versus a year ago. And Google talked about, Microsoft talked about 5 times more tokens processed in the March quarter versus a year ago. And then they started to put up pretty decent numbers as inference demand, the stuff it takes to generate your answers, overtook the training demand. And so that has kind of helped transition the baton. But if MIT is right, and 95% of the enterprises investing in AI are seeing 0 return, that's a problem when you're almost 3 years into this AI build out since we heard about ChatGPT at the end of 2022.
All right, Dan, great stuff. We have to leave it there. Dan Niles, founder and portfolio manager at Niles Investment Management. And I just want to draw your attention to two big movers in the after-hours trades. Ambarella, which is a maker of chips and kind of video compression using AI. That's one of your biggest gainers in the after-hour trade. But one of your biggest decliners right now is Gap. The shares were down as much as 11%, now down 9%. They just reported earnings. Comp sales did appear to miss analyst expectations, and a lot of talk in this release right now about the impact of tariffs. We're going to have that conversation in depth when we come back after the break right here on Bloomberg. Apparel maker Gap just reported earnings. This has been a turnaround story, and up until today, it had been a relatively positive one. The share is down about 8% in the after-hours trade after the company said comp sales in the second quarter came in at 1%. The street was looking for almost 2%, about 1.7%. Comp sales at Old Navy up 2%. That was better than expected. Comp sales at Gap Global were up 4%. That was actually better than expected. But you did have some weakness there in the Athleta business. That was down 9%. Now, here's the issue. The company providing a forecast saying that net sales for the current quarter will be in a range of 1.5% to 2.5%. That's a pretty wide range. But it says the gross margin will be impacted in a big way by as much, 2 percentage points because of the effect of tariffs. Deborah Weinswig joins us right now, the CEO of Coresight Research, to talk a little bit more about this. And we also, of course, we had Ulta Beauty shares up there on the screen, which seem to be doing well. But let's start off with the tariff impact here. That's a huge hit to margins to have a 2 percentage point hit. And I am curious as to why you don't think we saw a little bit more mitigation by management there to blunt that impact.
First of all, thank you for having me. Secondly, like I said, it's not often that my jaw drops and you just can't believe the size of this number, because we haven't heard anything even close to that from any other retailer or brand. And, the fact that they haven't had better kind of, tariff mitigation strategies, that they didn't talk about that more in the press release, I mean, that says that this is something that is almost beyond their control, which I would say is concerning, and I think the stock is reacting as such.
Well, that's what I'm curious. I mean, what would you actually expect to hear out of Richard Dickinson on the conference call and beyond? Because we're already in the back-to-school season. I mean, anyone who has kids has basically already done their back-to-school shopping. We're already looking ahead to the holiday shopping season. And if this is a company already guiding into the next 3 quarters with a hit from tariffs, what levers, if at all, would they have to pull?
I mean, it would have to be on the top line, but I think even that was disappointing this quarter. And so, if we start to look at kind of a 2-year stack, right, and they've had a kind of long way that they've been digging out of, but I think that they are kind of flattening out in terms of the degree of improvement in top line. And if you can't work that down to earnings right through the bottom line, and the number one thing you're calling out is tariffs, I mean, let alone other challenges like shrink, et cetera, it gives one cause for concern truly on the leadership there.
I am curious. I mean, you've been in this space for a long time, and you understand how these retailers operate. And there's always been challenges over the years. If it's not tariffs now, it was something 10 years ago and something 10 years prior to that. What are you seeing at other retailers in their ability to manage the tariff impact? What are they doing right, if at all?
That is a great question. So we had talked to a lot of our clients, and it was like, get as much in as you can, as early as you can, because it will not only remove a lot of the uncertainty, but also, right, you won't be faced with the same degree of potential tariffs as others. And I think, going back and forth, I mean, Ulta obviously in a different space, but they saw an incredibly strong gross margin this quarter. And they have their own brand as well. And so there are definitely levers to pull in terms of, supply chain risk, tariff risk. And it just doesn't seem like that was top of mind for Gap at this point, which is quite surprising.
We only have about 30 seconds left, Deborah, unfortunately. Pricing power. Where does that stand right now in the retail space? Who has it?
So going back to earnings last week, we had expected to see, Walmart, I think, had talked about pushing back on their vendors. We didn't see as much as we would have expected, but I think they've said they're trying to kind of share some of the burden. Yeah. Another company, Tractor Supply, has said, right, same thing. They're working with their vendors, but what we're seeing is those kinds of companies that are seeing significant opportunity to really share the pain.
Yeah.
And I think that, there will be more to come.
All right. Thank you, Deborah, Coresight Research CEO. Let's get right to our top three, the people driving some of the day's most talked about stories. And we start with Xi Jinping. Bloomberg reporting China's president quietly reached out to India all the way back in March to test the waters on improving ties. This, of course, amid a lot of concerns here about the U.S.'s trade policies toward Beijing and India as well. Next up, back here in the U.S., Susan Monterez. She's the CDC director, at least for now. She's been ousted by the Trump administration, according to the Trump administration. This after clashing with RFK Jr. over her views on vaccines. The Health and Human Services Secretary, RFK Jr., saying that the CDC, which is under his purview, is likely suffering from a, quote, deeply embedded malaise. Third, Lisa Cook, the Fed governor, filing a lawsuit challenging President Trump's attempt to fire her. Her lawyers suggesting an unintentional clerical error may have been behind some of the discrepancies on her financial disclosure forms regarding at least 2 mortgages that she took out back in 2021. Now, we've been following that case, and we continue to follow the lawsuit now that Lisa Cook has filed. So, too, has Elliott Stein. He's senior litigation analyst for Bloomberg Intelligence, and he joins us here around the desk. I want to kind of juxtapose 2 sort of firings, and I kind of put those in quotation marks. Lisa Cook over at the Fed and Susan Monterez over at the CDC. When we talk about the legal standing to push back on Trump's attempt to oust these folks, who has a bigger leg to stand on?
Well, there are so many cases concerning President Trump firing commissioners of various agencies, and we've seen a distinction between the Federal Reserve and pretty much every other agency, including the CDC now, because even last night, and what's interesting is Abby Lowell is a lawyer for both the CDC director and Lisa Cook.
Busy.
Yeah, and you saw the CDC director's lawyers last night put out tweets saying, essentially conceding that the president could probably fire her, but they contested some of the procedural mechanisms that resulted in her being removed because it didn't come from the president directly. And so, you really need to contrast that with the Federal Reserve, which the Supreme Court all the way back in May said is uniquely structured, it's sort of more quasi-private, and as a result, it doesn't really fit under the president's authority to remove those people at will.
You've had a chance to look at Lisa Cook's lawsuit. What exactly is she saying in that document?
Well, so she's saying that the Federal Reserve Act has a 4-cause removal restriction, which, again, the Supreme Court hinted in May is a constitutional removal restriction, and that the president hasn't satisfied that standard because what he is accusing Lisa Cook of doing is really just an allegation at this point. There's been no investigation, and he can't make that determination solely on his own. There has to be some sort of process. She has to be given due process to contest these allegations at a minimum, and none of that has happened.
None of that has happened. There were several Trump administration officials that came out and said that at minimum, Lisa Cook should, I guess, effectively recuse herself in the interim as this case plays out. I know we're kind of in unprecedented territory here, but is there some legal precedent to say that you should not be involved in policymaking while this legal process plays out?
Really, that's for a court to decide, and we're going to have a court hearing tomorrow at 10 a.m. on Lisa Cook's application for a temporary restraining order, a TRO, because that's essentially what she's seeking. If you ask President Trump, Lisa Cook is fired. If you ask Lisa Cook, she's still a Federal Reserve Board governor because President Trump's letter has no legal effect.
This matters a lot because we're 3 weeks away from another Fed meeting, less than 3 weeks away, really, from another Fed meeting. The decision tomorrow, is that effectively, at least for the short term, going to be the definitive decision as to whether she's going to be participating in that meeting in a couple of weeks?
For the short term. And we don't know if the judge will decide tomorrow. The hearing's tomorrow. I think there's a good chance the judge will decide on the TRO application tomorrow. That will stay in place for potentially 10 days or 2 weeks. Then Lisa Cook would either ask for that to be elongated and stay in place longer as a preliminary injunction or even as a permanent injunction. And presumably the president will go to the D.C. Circuit, the appeals court, and ask for the TRO to be dissolved, essentially.
Yeah. All right. Elliott, Stein, our litigation analyst over at Bloomberg Intelligence. And of course, we will have a full coverage of the results that come out of that hearing tomorrow morning as we continue our coverage on the close this afternoon. A big question mark as to whether Lisa Cook will actually be part of the Fed's next policy meeting, September 16th and 17th. And there's a possibility that a new Trump appointee could also be part of that meeting. Stephen Myron, apparently the Senate is now rushing to actually hold a hearing on his nomination to the Federal Reserve Board as soon as next week. All of this coming against the backdrop of a PCE inflation report that is set to come out tomorrow morning. Frances Donald is the chief economist over at RBC, and she joins us now. And Frances, there's a lot to unpack here. We're talking about the economy, we're talking about the data, and of course, we're talking about a lot of the politics swirling around the Fed. I want to start with first this PCE report. It's an inflation, it's a personal consumption, inflation expenditures, inflation price index report that most people think is going to ratify this idea that the persistence of inflation is still there. Is that your outlook?
Yes, but maybe not for the reasons that others may be discussing. So all the focus right now on inflation is related to whether tariffs are going to show up. Our take is that it's too early for tariffs to show up because companies still have to run down serious inventories before we see numbers like the PCE and the CPI start to show goods inflation. What we're looking for in this report is more signs of that services inflation holding in too strong, uncomfortably strong. And the problem here is services inflation. Well, the Fed is sensitive to that. It's more nefarious, and it has to do with that tighter labor market. It's going to be stickier. So that's the challenge, and that's what we're going to be looking for tomorrow, not the tariff story. That's a later 2025 story, but how persistent is services side of the picture.
What did you make, though, of Jay Powell's presentation about a week ago, where he seemed to put a little bit more emphasis, at least that was the interpretation, on the state of the labor market rather than on tariffs and inflation?
Well, that's the challenge. You and I are used to that dual mandate heading in the same direction at the same time, but we are now in what we call stagflation light, which is growth in labor that's uncomfortably low, but inflation that is uncomfortably high. The Fed could choose from a range of indicators to cut or, frankly, even hike if they were just going off of the inflation side. So we have to listen really carefully to what the biases that exist within this Fed are. And clearly, this is a Federal Reserve that has not ruled out a September cut. Our take, however, is that they're not going to have the right data that permits that, and it's going to be hard to cut before December. But again, the Federal Reserve can choose to speak to a variety of different indicators, for example, those recent non-farm payroll numbers, and say that's enough for us to want to move now. I'll just say this one thing, Romain. We are still at 4.2% unemployment rate. That's exactly where we were last year, and yet inflation is cresting around 3%. That's not exactly a clear-cut easing cycle type of data landscape. So the Fed can navigate this, but they're going to have to get really tricky with what kind of words and data points they use to justify.
That actually brings us, though, to the makeup of the Fed, and it could look a little bit different in just a couple of weeks' time. Stephen Myron, who's going to be nominated to the Federal Reserve Board, could get a hearing as soon as next week, which would rush him onto the board ahead of that meeting. And of course, the courts may have to actually decide, be the arbiter, or whether Lisa Cook is going to be in that room as well. Does that matter to what the outcome might actually be with regards to the monetary policy decision on September 17th?
Probably not for September 17th, but absolutely when you're looking at some of the potential erosion of that Fed independence over time, it can't be something that's entirely dismissed. Call me a traditionalist, but for me, it always comes down to no, not who's in the positions, but what is the data showing us? And our take is that that upside uncomfortableness that happens in the inflation is probably going to make the Fed's job very difficult come September. That's going to be what the markets latch onto, in addition to some of the noise and the politics around the Fed composition.
What did you make of the GDP data revisions that we got today? Obviously backwards looking, but we're talking about a 3.3% growth rate. Under any circumstance, that would be phenomenal for a country our size. But it did seem that the majority of that was driven by investment spending, business spending, I should say, tied to technology and AI that a lot of people don't necessarily think is sustainable.
Well, let's say this. If you were in a coma for the last 5 years, you woke up, I told you GDP was 3.3%, the unemployment rate was 4.2%, and inflation was above 2%, you'd say, the economy's booming. It's running almost on too hot side of the picture. We wouldn't be talking about material weakness in the labor market. We wouldn't be talking about a significant slowdown. Now, looking forward, you're right. Some of these factors that have supported growth are going to slow down. We should be looking at something more like 1.5% GDP if you average out the second half of the year. We're not going to see CapEx that strong. Housing is effectively in a recession, and then high-income consumer is showing some signs of slowing. We're going to be watching that personal spending number tomorrow for that as well. But it's really hard if you look at a blank piece of paper and add in the data where we are now to make justifications that this economy is in serious trouble.
All right, Francis, got to leave it there. Francis Donald is the chief economist at RBC, 8:30 a.m. tomorrow, Washington time. We are scheduled to get that PCE report, and we should also point, as Elliott Stein just talked about a little bit earlier, we are all expected also tomorrow morning to get maybe potentially some sort of decision regarding Lisa Cook's status on the Federal Reserve Board. As we take a look here at the after-hours trade and some of the big gainers and decliners in that space, keep an eye on Gap. The shares had been down as much as 12%. That company saying it's going to see a major tariff impact up ahead for the next quarter. Those shares now down about 5%. Meanwhile, Ulta Beauty, also in the same retail space, saying it's not seeing the same pressures and it's still seeing pretty healthy consumer spending. Affirm and Dell moving in opposite directions as we take a look at what's been going on in the technology space and, of course, the AI build-out. We'll be back in a moment. This is Bloomberg. Well, the college football season here in the U.S. is already underway, though we should point out the big games ostensibly start today. A big game tonight, a little bit later with Boise State and South Florida, and a marquee matchup coming up on Saturday between Texas and Ohio State. But a lot of doctors out there are bracing for an impact that maybe we didn't see in the past. This is college athletes raking millions of dollars through their name, image, and likeness deals. This means that team physicians are now faced with the heightened risk and liability for their decisions as to whether to put folks back out on the field. A precarious and increasingly visible position for medical professionals. Our next guest has a key perspective on this issue. After all, he is the president and CEO of the U.S. Council for Athletes Health and the chief medical officer for the Big Ten, Dr. James Borchers. Dr. Borchers, great to have you here on the program. You know, I hadn't really thought about this angle before as someone who also played sports. I mean, we all kind of know, there's kind of this idea that you get hurt as long as it's not like a broken bone or something like that. You dust yourself off and you get back out on there in the field. But if you're a college player who's making hundreds of thousands, even potentially millions, off your name, image, likeness, is this going to now force the hand of some of those medical professionals with regards to the decisions that they make?
Yeah, well, first of all, thanks for having me. You're exactly right. There's a new variable that's been introduced into collegiate athletics through name, image, and likeness and revenue sharing. And it is this impact of finances and the financial impact that some of these athletes face if they are not on the field. And so now physicians, medical personnel are now looking at this additional variable when an athlete may not be able to return to the field. And certainly there are questions now because, as you know, these athletes are not employees, about what that means and what it means for the medical professionals, and looking at what's happened in professional sports, what some of the ramifications can be if there's a disagreement about the decisions that are made or the recommendations that are made from those team physicians or medical professionals.
I am curious about how many cooks are in this kitchen. I mean, you have a unique perspective, not only being a medical doctor and currently an advisor, but a former player yourself. And I think we're kind of the same generation. And it seemed to be a decision back in the days, usually between maybe the head coach or the skills coach and maybe and whoever the doctor was on the field. How many other people might end up having to be part of that decision-making process today?
Well, I think there's definitely going to be the representatives of the players. You now have agents that are involved or agencies that are representing players. And they're certainly seeking out opinions of physicians that are not part of the university or the institution. And they're going to have an impact on what the recommendations may be, or there may be a differing of opinions. And so trying to reconcile that, working with the athlete and making certain that the best decision is made to get them back out on the field, but understanding what their decisions are when they think about their financial decisions. And we've seen some of this with opting out of bowl games. We've seen some of this when thinking about taking the next step to the NFL. But we now have a new market in collegiate athletics, where individuals are not only making a lot of money, they're looking for opportunities to make money, either moving through the transfer portal within their own institution. So there's a lot of new variability to this college athletics scene.
There's one other aspect to this that has been raised as well. Beyond physical health, there have been questions about how you approach potential mental health issues with these athletes, particularly with some of the money that might be at stake.
Absolutely. You're talking about in collegiate athletics, late adolescents, young adults who may not have dealt with any of these variables. The pressure now that is on them to produce, not only to produce on the field, but to produce financially. And so there is significant, stress. There can be significant anxiety. You take an 18-year-old who's performing on a big stage and now has these sorts of financial issues along with it. There can be a lot of stress, a lot of mental stress, and certainly the support needed there for those individuals to be able to perform.
All right, Dr. Borchers, I have to leave it there. Really appreciate you coming on. I want to ask you who you're rooting for in that Texas-Ohio State game. Dr. James Borchers, the president and CEO of the U.S. Council for Athletes' Health. Now, if you're a sports fan, this is your time of year. This new era of hyper-popular college players coming to the fore this weekend with those big games, Texas versus Ohio State. And don't forget, my alma mater, Northwestern, of course, taking on, the mighty Bulldogs there. You also have the U.S. Open in full swing here in New York, and all that a big reason, of course, to bring all of the power players in sports under one roof here at Bloomberg World Headquarters. Jason Kelly is the host of The Deal and Power Players, and of course, he is the one leading that charge. You have a big event here next week where you're going to be a lot of athletes and a lot of people in the business of sports to talk about just how much it's involved. And we were just talking with him about name, image, likeness, something that we couldn't talk about just 3 or 4 years ago.
Totally, and it's at the fore of what we're doing. So Power Players next Thursday. We're very excited to bring everybody here to Bloomberg World Headquarters, as you say, as the U.S. Open is happening. And speaking of which, Maria Sharapova, she just went into the Tennis Hall of Fame. She'll be here in conversation with David Rubenstein. But to the point of college sports, we're going to have the athletic directors from Ohio State, UCLA, Dartmouth, and Duke all talking about this unbelievably new era. I was fascinated by that conversation with Dr. Borchers. I hadn't even thought about that. I mean, I do this for a living. I hadn't even thought about that.
Yeah, and it really, it complicates. It's good in a lot of ways for the players, obviously. And there's been a lot of talk over the years about making the college football business more equitable. But it does introduce just a different dynamic into the decisions that have to be made. So when you get up there and you start to talk to these folks, the types of questions they're going to be asking them, are they going to be amongst the line of how to protect these players, how to maximize their value? What's the balance?
I think it's yes and. I think what we really are starting to see, and it was interesting again to listen to that conversation, we're all figuring out how this is going to work. One of the questions I have, and Janet Lauren, our colleague, is going to be leading that conversation with the ADs. One of her questions I know is going to be, how much are you paying these players? How are you actually paying them? Are you worried they're going to leave? Are these prices going to go up? There's a settlement that each, school that's bought into this has about $20 million to pay players. Is that going to be enough going forward? You have players who, between NIL and what they're getting paid by their schools, are making, $10, $12 million.
Well, one thing I'm interested in with your event next week, you go back, probably when we were kids. There were kind of 3 sports, more or less. It was, football, baseball, basketball, and maybe hockey, depending on your region. But now we're talking about the WNBA, women's basketball has become this big force. You have a lot of MLS, Major League Soccer in this country has now become a big business. And you're going to have a couple of folks from that realm also on stage.
Exactly right. So we'll have Don Garber, who is the commissioner of Major League Soccer, and Cindy Cohn, who runs U.S. Soccer. Keep in mind, a year from now, we will be on the back half of the World Cup. It's going to be here in North America. So we've got to talk to them. One of the questions I have, to be honest with you, Romain, is why aren't we talking more about the World Cup? It feels like I sort of have to remind myself this is coming. I feel like if you and I were sitting in London, it's all we'd be talking about a year out. So where's the hype? How big of an event is this going to be? So,
particularly because we just had the Club World Cup final here in the right here in New York.
Exactly.
New Jersey,
And you know, when we last had the World Cup here in the United States in 1994, that gave birth to the MLS. So what is this going to give birth to? Is this finally going to be, you know, this has been, you know, the next big thing, soccer, as long as we've been around.
All right, Jason, something to look forward to for next week here on Bloomberg Television and beyond. Jason Kelly, the host of The Deal, and Power Players. And you can catch our coverage of the Power Players Summit next week with some of those names he just talked about, like Maria Sharapova, Justin Tuck, and Carl Anthony Towns. All right, before we go to break, I just want to bring you an update here on some breaking news involving Caterpillar. The shares plunging here in the aftermarket, down 3% after the company now articulating the impact of tariffs on its business. Basically, the company says that it sees a net impact for the full year of $1.5 to $1.8 billion and says that that will take its operating profit margin down to the bottom of its previous range that it had guided for. Though it does say there will be no impact on sales or its revenue outlook. So again, they're saying this will be a margin story, but a pretty big one of at least $1.5 billion. This is Bloomberg. Some breaking news here on the Centers for Disease Control and Prevention here in the United States. The Washington Post reporting that the Trump administration is now pushing James O'Neill to take over the CDC. This after the Trump administration moved to oust CDC Director Susan Montmorency. James O'Neill, of course, has been a close ally of Peter Thiel and actually ran Thiel's foundation for at least about 3 years a few years ago. We'll try to get you some more details on that, and the team at Balance of Power, I'm sure we'll have some more details as well as we close out our coverage here on the close with a push ahead to some of the things that could move the markets tomorrow, including some earnings out of Alibaba and BYD. Of course, two big Chinese companies with two big imprints here on the global picture. We're going to get the economic data, the PCE price index at 8:30 a.m. time, University of Michigan sentiment numbers at 10 a.m. And don't forget, midnight tonight, that de minimis exemption that has been in place going all the way back to the 1930s, that's going to be lowered from $800 to $100 starting at midnight. Could have a big impact on the e-commerce sector. That does it for us here on the close. But stick around. The intersection of what's going on Wall Street and Washington, that comes up next on Balance of Power.